Welcome to the fun and mentals of real estate. I've got a question of the day for you.
Yes, what's my question?
The question is, Glenn, how do you predict the future?
To predict the future, you need a DeLorean, you need the flux capacitor, you need a crazy scientist friend, and you go to the future and then you come back and then you can tell the future.
I see.
So the point is you can't predict the future. Nobody knows the future.
Nobody knows the future. Well, are there some signs that we can look at maybe to help predict the real estate market here in St. Louis?
Definitely, and I think you can look at trends, which I know you do a great job of this. The data nowadays is so accessible, mostly to real estate professionals, but you remember the old-fashioned days when they put that data in a book, they would send it to a printer, the
Yeah.
printer would print it, and then you would get the information about the real
Yeah.
estate market. Or you'd have to look at mainly national trends. It wasn't that accessible locally, but I would say the last 10, 12 years, and even speeding up more in the
A
last
lot
2
more
years,
data.
the data it's a lot more data and it's available a lot quicker.
Well, let's just talk about data. So, numbers, they are the language of real estate.
They really are. And if your
Yes.
real estate agent isn't talking numbers, then you need
Yeah, if your
somebody that
realtor is
understands them.
mimicking national news, you might be a little bit in trouble. So let's let's have a little analogy here. So, national stock market, it's going down, it's going down, it's going down.
Right.
The house is burning down. I'm like,
Yes.
oh my god, I gotta go sell my stock. But your stock that you really have in your portfolio is maybe an AI stock or a Bitcoin or
Maybe utility
right?
or something local,
Yeah,
right? Yeah.
and you're like, that one's going up. So do I want to sell it just because the national market's going down? No. All right, and so that is the difference between your national numbers
Right.
and your local numbers, right? And so there are some key metrics that we do look at in real estate in order to figure out what's happening, what's going to happen in the next few years.
So you're looking at shifts and trends, and just explain to me, what do you consider a metric? What does
That's
that
a
mean?
statistic, right?
Statistic.
It's a number, and so the numbers don't lie, and so we're able to look at a few key numbers, statistics,
Sure.
metrics, right, to figure it out. So let's just talk about what they are.
Yeah.
There's a few things that drive them, which we can talk about too, but let's talk about what the actual key metrics are. So the ones that we look at to see, is this real estate market shifting? Is it appreciating? Is it depreciating? Is it going to crash?
And there's really
Right?
basically two types of markets in real estate. There's the buyer's market, which means there's more homes for sale than there's more homes for sale than there are buyers. And then
There
there's
you
seller's
go.
market, to where there's more buyers than there are
Then
sellers.
more buyers. It's simple
And-
supply demand.
And we've been in the seller's market, meaning the market favors the seller for how long now?
Oh, going on 11 years now. Since
11
2015.
years,
Yeah.
the market is favored the seller, and that's why we've seen this crazy appreciation.
Yeah, there's no doubt about it. So, in your local market, things that you do want to look at are definitely how many homes are on the market, right? Supply, demand.
And who's providing you this information?
Well, so it comes right out of our MLS
So the realtors all have all their
and
information
right
in.
from St. Louis Association of Realtors.
Right.
We see national trends from the National Association of Realtors, but we get our local numbers straight from our St. Louis Real Estate Board and straight from our local MLS that's compiling the data here for the St. Louis metro area. So we're looking at metro area of a whole, and also you're going to want to look even more specific into a zip code or into a neighborhood.
Or school
right?
district.
School district,
Yes.
right? And so you're going to want to really drill down.
It's almost like micro data, right? We've got
Micro
yes.
data. Right, so let's just talk about inventory levels. What does that mean, and what is the actual key statistics? Well, there is actual an inventory number, how many homes are on the market. Then there is the month supply. And month supply basically is if all the homes stayed on the market, all the homes that are on the market right now, nothing new came on,
Right.
how long would it take for those to sell, for the market to absorb those homes that are for sale?
Okay.
Right, and so that's called month supply. So when we look at month supply, where anything under 5 months, really 6 months, is considered a seller's market.
6 months. That seems like a
I
longer
know.
time.
It feels like
Yeah,
a
I would be.
buyer's
I
market
know if I
is
had my home for sale now and it doesn't sell in 6 minutes.
Yeah, that's right.
I feel
you
disappointed.
You feel disappointed.
Right.
A buyer's market's anything outside of that. Now, there's another key metric that we use when we're looking at the supply versus demand. How do we gauge the demand, right? Now we know what the supply is. What's the demand? The month supply absorption rate kind of tells us what demand is, but there's another number, and then we use that really super specifically in zip codes, neighborhoods, right? School districts, and that is the number of homes that are on the market now, actively selling and showing, right? Let's just say there's 12 of them in your zip code.
Okay.
And in your price point even, right? And your 50 grand spread price point or your 100 grand spread price point, let's just say between 3 and 350 in Baldwin, there's 12 homes on the market. And also, then we look at what's under contract at the same time.
Under contract hasn't sold yet, right?
Yes, it's not closed yet, but it is under contract, and they're going through their motions of inspections and loans and that sort of thing. And let's say there's another 12 that's under contract. So of the 24 available,
Half
12
of them.
are under contract. That's a 50% under contract rate.
Okay.
So anything above 30% is a seller market.
Above 30.
Above 30%. So that's a strong seller market at 50%. Anything below 30 is a buyer, and balance is right around 30. You don't stay in balance markets very long.
Right.
I mean, you really don't.
They're going up or
they're
down.
They're like a blink of an eye.
Right.
A balance market. So basically everything right now, when I look at numbers, I'm comparing the 2019 market. So the 2019 market was pre-pandemic.
Right before COVID.
Have we at least gotten back to 2019 levels? And that was a seller's market. We had multiple offers, not on steroids like the pandemic year, but we had really low inventory even in 2019. Well, for single families here in St. Louis, we are 1/3 lower in available homes than 2019. We are third low on inventory.
So in a little less than 6 years, less than 6 years, we've got a third fewer homes for sale.
Third fewer homes for sale. Now in condos are now back to the 2019 level.
Interesting.
Yeah, so that market, that inventory's doubled in the last 2 years because of taxes and insurance and
HOA fees,
which causes the HOA fees to raise. So we're seeing a lot of HOA fees raise, and the condos are coming on the market a lot. That's starting to slow down. As at the rate that they've been coming on is starting to slow. And the condo market's still appreciating.
It's amazing. It's slowing down, but it's still appreciating.
Right. And so that's, so when we're looking for a shifting market, or, hey, what's the trend, appreciating, depreciating, we're also going to look at days on market.
So days on market are going to tell me how long it took to get my house sold.
Right.
Is that days between I put it on market and it's closed, or days between I put it on the market and went under contract?
Days on market. So when I put it on the market and it went under contract.
Not closed, but under
Not
contract.
closed, but under contract, right.
Okay.
So how long is that? And right now in St. Louis, for January through July of 25, that's 30 days.
And that's
a very fast
very short time, yeah.
Most of ours are all going first weekend, but 30 days is the average, and that's a fast seller market.
And that's a good thing to bring up, because we're seeing maybe nationally, they're talking about that's going higher. It's slowing down. They're not going as fast, but in St. Louis, they're still going fast.
Yeah, the national month supply is like 4.5. Ours is single family 2.5.
And really, you can't say, well, my aunt's house, it's set for 6 months, but my friend's house sold for 2 days. You're looking at all the data from the St. Louis metro area. And all this is micro data, and we can drill down to school districts, even subdivisions if you want. It's still not ones or twos.
Right. But we're trying to get a little bit more in real time and not look like we used to, look so far back over the last 6 months or a year, because that's past data. What's going on right now? Well, that rate, under contract rate, is a real-time number. The other real-time number would be just the number of showings.
Ooh, that's an interesting one. So how many people came in?
The foot traffic.
How many people?
Right?
So how do they track that with the MLS? You have to register every time you show a home?
Yeah, it's most of it is online registering, so they can keep track of it. It's kind of like the number of mortgage applications for you, right?
Right.
You know, if you've got 50 mortgage applications, you're probably closing a lot next month or in the next 2 months.
Right.
But if you only have 10, then you're like, whoa, what just happened? You know your foot traffic has slowed down, right?
So you look at how many people came in and physically viewed the house until it went under contract.
Well, just how many are viewing, and then how many are viewing until you get a contract. Right. So it's been about a 14 showings to get under contract.
And the lower that number, the more competitive the market's going to be, right?
Well, no, you want that. Well, yeah, the lower to a contract.
Right.
That's true, but you want high number of showings. You want, like, first weekend, we used to have 100 during COVID.
Wow.
then it was 50, then it was 30. Now you really shoot for that 10 to 20 if you can get them,
So tell
right?
me,
If you don't get 10 to 20 and you're not in that 10 to 14 range, you may or may not get an offer. I've had some with just 5 showings, we get a great offer over asking all the things because people are still conditioned that things are going very quickly.
and I know there's some of them that don't, they go into contract even before they have any showings. I've heard of that happening too.
Oh yeah,
Yeah.
well, that's for
It's got to skew your
that
number.
still does
Right.
happen some. Now, another thing that we look at is price reductions, right?
Oh, okay, yeah.
Right, we look at those. The other thing that we're looking at really now is just affordability. So we're trying to look at the affordability number even to
That's
see.
a big one right now because the
Right?
taxes, not only the price of houses going up, the taxes, the insurance, the interest rates,
Hmm.
it's making homes unaffordable.
Yeah, these are the things that start affecting the key
Right.
metrics, right? So what affects these key metrics? Well, affordability, right? So at 150 score, St. Louis is very happy.
Right.
Well, everybody's very happy. Sellers are happy.
And
Buyers are happy.
do you know what all goes into that 150, or is that?
The affordability
Yeah.
score, it's the percentage of the income that's needed to buy your home,
Okay.
right? And so right now, the score for single families is down to 97. It's the lowest I've seen it.
And low is bad, right?
And low is bad.
And low is bad.
Well,
High.
low, you want a high affordability
Right.
score. We used to be in the 200s and
Wow.
over 200, right? During the downturn, and even just before the downturn, it was way better affordability.
And that downturn was, what would you say, at 07, 08, somewhere around there?
Yeah,
And we
so
saw prices drop.
even during that, the affordability was very much higher than it is today.
Yeah.
Because the house of the pricer was lower.
The
right?
prices were lower,
Right?
right? And even though people are making, wages have improved. I know they have
Very
slight,
much so.
but they haven't kept up with the price of the house going up.
Yeah, I mean, in some areas they have, in some respects, they've been very close with
Yeah, okay.
inflation pulling back and starting to, come down at least from its 9%. Inflation's another thing. We look at inflation. Inflation's going to affect that key metric.
And that should help with inflation going down. I mean, it was 8, 9, 10%. Now we're down to 2.
Affordability everywhere else, right?
Right.
Your cost of living, your cost of your eggs, which used to be $8 a dozen here
Not for
in
me.
St. Louis. Now they're like $4.
Right.
Now the other thing is the size of the first-time homebuyer pool affects these key metrics. So when we know that first-time homebuyer pool is really big,
It is huge right now because
Right.
what do we say? The average age of the first-time home buyer is 38 years old.
it went up from 30 to 38. It's really super high. But the size of the millennials is as big as baby boomers, and so is Gen Z.
Right.
And so these two big buyer pools and millennials has still not bought to the level they should be buying, or that baby boomers bought when they were there.
Well, the inventory there's a whole lot of things working against them. The inventory is low too. So we've got all these numbers. So
Yeah.
how do these help you predict the future?
So right now we know, again, another thing that affecting the supply is just lack of inventory.
Right, we're not
And
building.
the reason we have lack of inventory, everyone's like, why is the inventory low? I don't understand. And it is because of that downturn where the builders went belly up. You probably know
I
a
was
lot
there.
of them,
Yes, I did. That
right?
was miserable.
They were caught holding the bag. A lot of them went bankrupt even. And so we didn't see a lot of building. Again, we need a million homes to keep up with household formation, and 1 million homes did not get built every year.
And we're
It
5
did
million behind
We're
nationally.
about 4.5 to
And
5
and that
million
were
behind.
affects here in St. Louis.
Yeah, it affects big time here in St. Louis and all across the nation, but big time here. So because this supply demand, they're only building at a rate of about 1 million to 1.1 million a year.
We're
so
not
they're
catching up.
They're keeping up, but not catching up,
Right.
and that's the problem. And so since we know supply is going to stay low, and we need these rates to come down a little bit, but as soon as rates come down,
It's going to bring more buyers in,
you're
isn't
going to see
it?
a big buyer pool, and you're going to see another increase in
The
prices.
pricing. Yeah.
So St. Louis, very affordable, 7% appreciation last year. These key metrics are what we're looking at to see if we're in sellers markets, buyers markets, or if it's starting to shift. And you need to know this when you're buying and when you're selling.
Of course.
Right? And
Yeah.
if your
How I'm going to
agent
price
is,
my house.
Again, if your
Yeah.
agent's mimicking national news, it's not a good thing. You need to really drill down locally.
You got an amazing agent like Angie who studies these numbers, familiarizes herself, and then you use these numbers. You use them when you help people price their house. You use them to help the buyers. But if I was to say, Marty McFly has come back from the future, I'm sure he would say, buy a house today.
Buy a house today.
Because it's not going to get cheaper.
This is why the prediction is 17% more appreciation here in the next 5 years in St. Louis. And all these factors play into it.
They sure
all
do.
these factors play
Yeah.
into it. So hopefully that helps you kind of demystify where this market's going. And a crash?
No, it's
No, there's not one metric or anything affecting the metric that would indicate a crash is anywhere in sight.
stocks, bonds, gold, so whatever.
Right.
Real estate is a safe, secure investment. It provides you shelter, and those people that are 38 years old and haven't bought a house, they're really missing out on that
Yeah,
appreciation.
you need to buy, and don't use your national stock market news
Right.
that it's going down to go sell your local stock that's rising. Same thing with real estate.
So I think this was fun and mental. Very mental, but fun.
A little mental, a
Yes.
little fun. So hopefully it helps you out with your real estate investments.
Heck yeah.
And you should buy and help your kids buy and your grandkids buy right now because they need to get in the game because of the supply
Don't
demand
be picky
issue.
on that first house for sure.
Absolutely. Well, thanks for joining us this week. I'm Angela Dillman with Keller Williams. I'm here to help you build wealth,
Live your dream lifestyle,
and leave legacies that matter. Thanks, Glenn.
Yeah.
Glenn with Glenn with Guild Mortgage.
They know who we are.
See you
Thanks.
next week.